Good evening and welcome to DLF Limited Q3 Financial Year 24 Earnings Webcast. Thank you for joining us today. We are happy to announce that our business continues to deliver a consistent and strong performance across all parameters. I'll start with financial highlights for Q3 Financial Year 24 DLF Limited consolidated results. Consolidated revenue stood at rupees 1644 crores, gross margin at 56%, EBITDA at 633 crores, net profit at rupees 649 crores, reflecting year-on-year growth of 26%. Healthy surplus cash generation from operations at rupees 1108 crores. We recorded our highest quarterly sales booking of rupees 9047 crores, backed by multiple launches during the quarter. We launched 3 new products of 5 million plus square feet during the quarter across multiple segments. The launches during the quarter includes DLF Privana South, Gurugram, a luxury high-rise development, Central 67, Gurugram, a shop-cum office plotted development, and the Valley Orchard, Panchkula, low-rise independent floors. We witnessed healthy demand momentum across all these products, and both projects in Gurugram were completely sold out within a record time. With this strong performance, the new sales booking for the 9th-month period stood at rupees 13,316 crores and hence will exceed our full-year sales guidance. We would like to highlight that with this performance, we have broadly achieved our guidance on new product launches that we had given 3 years back, along with an upside in sales potential due to value enhancement across the products. The sustained demand momentum across all segments continues to be encouraging. Consequently, we have identified a fresh pipeline of new products of approximately 32 million square feet with the sales potential of approximately 79,000 crores, which is more than double of what we have delivered during the last 3 to 4 years and is in line with our plans of scaling up the business. We expect to launch these products over the next 3 to 4 years. The key launch that we are working on for the next 12 to 15 months are products in Gurugram, Chennai, Goa, and the first phase of our Mumbai project. Collections continued to be at record levels, resulting in record cash flow generation during the quarter. Consequently, our net cash position at the end of the quarter improved further to rupees 1246 crores. Further, the board, in line with our stated strategy to consolidate the rental business, has approved transfer of DLF Center, a marquee asset in Delhi, to DCCDL at an aggregate consideration of rupees 825 crores plus minus 5%. This transaction will be subject to due diligence, documentation, and requisite approval from the shareholders. I'll now move to the financial highlights for Q3 Financial Year 24 DLF Cyber City Developers Limited consolidated. Rental income grew at rupees 1,089 crores, year-on-year growth of 9%. Consolidated revenue of rupees 1,476 crores, reflecting a 8% year-on-year growth. EBITDA at rupees 1,126 crores, year-on-year growth of 6%. PAT at rupees 434 crores, reflecting a year-on-year growth of 21%. The credit rating for DCCDL was upgraded to ICRA AA positive stable during the quarter, vindicating the inherent strength and quality of our rental portfolio. Our non-SEZ segment continues to operate at healthy occupancy level of 97%. Our new office development across Gurugram and Chennai continue to garner strong interest from large occupiers, consequently have achieved a pre-leasing of approximately 91%. The government decision for the amendment in the SEZ regulation allowing floor-wise denotification should lead recovery in the SEZ segment too. We expect normalcy to return in occupancy levels in this segment over the next few quarters. Our retail business continues to deliver strong growth, and hence we continue to remain focused on increasing our retail portfolio across multiple geographies. We remain committed to our goals of delivering consistent and profitable growth, which is well supported by the strong performance in our residential business, healthy pipeline of new products, quality asset in the growing rental portfolio, backed by a healthy balance sheet and supportive market dynamics. With this, I'll end, and we can now open the floor for the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. To ask a question, please click on the Q&A tab on the panel and click on the raise hand button. The operator will announce your name when it is your turn to ask a question. Please accept the prompt on your screen and unmute your microphone while proceeding with your question. We will wait for a moment while the question queue assembles. The first question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity. So first question is on launches. Good to see a very strong pipeline now for next couple of years. You have already mentioned about projects in Gurgaon, Chennai, Goa, first phase of Mumbai. Can you elaborate or quantify more on the size of these launches that are expected next year? And what are the key additions in terms of projects beyond FY25 that you have mentioned?
Okay, so I'll hand over to Akash really for elaborating, but on an overall basis, the key projects that we are ready for launch now is clearly the next phase, and hopefully subsequent phases of our immensely successful launch in Privana. There would be a luxury project coming up on the Golf Course Road in DLF 5 for sure. We have a launch lined up in Chennai of a luxury project and one lined up in Goa. We will have the first phase of our Mumbai launch next year, and we'll have a smaller launch in Panchkula. Akash, you want to further talk about this?
So the super luxury project on the Golf Course Road will be about 450 odd apartments. That will be sometime in after the first quarter. Then there is the Privana, as we were just talking about. Privana 2 is another 800 odd apartments. Privana West was 1100. Chennai is going to be followed. Average size of apartments about 2400 to 2800 square feet. And then there's going to be Mumbai. The Panchkula is going to be another small development, but that will be size of about, say, 500 odd crores, floors and some commercial. So that's what we have right now. And in terms of value, we had earlier mentioned also, there is tremendous potential both from the point of view of luxury and super luxury across the board, across geographies. And in order of launches, we are starting with Gurgaon and taking, after these two launches here, we will move to Mumbai and Chennai.
Got it. So full 3 million square feet, which was expected, this year in DLF 5, is now happening next year, FY25, is it?
Yes, please.
And Mumbai would be 1 million square feet that we have earlier planned. That would be the first phase.
Yes, please.
Yes.
Okay, got it. I'll connect with Kuldeep separately for the details. So thanks for that. In terms of margin expectations now, considering we have we had a big launch with a very healthy pricing of 18,000. How should our blended margin track going ahead, considering we have been doing a lot in terms of pricing now. So that's my question on margins.
So I think obviously the margins will be driven by individual launches. As an example, the DLF 5 launch will obviously have the highest margin amongst everything. But overall, I think we should be ballpark in the pivot of 45 to 50% on an overall margin for new launches.
Okay, that should be the corporate margins and not the project level margins, right? I mean, that should be how blended the margins will look like at
Yes,
the P&L once these projects are recognized.
exactly, because you'll unfortunately still see a lag between the time that these are launched and until the time that these are recognized because of the accounting policy issues. Most of these projects should translate into that sort of margin. Yeah.
Sure, got it. And just one last, I mean, these things are really looking very good in terms of size of the, sales that is happening, 7,000, 8,000 crore getting sold out within, 3 days odd. Are you at all, worried with how things are picking up, so fast? And specifically, obviously you would have also known a few of the Arbor units that were sold out that are again coming back to market at a premium kind of pricing. So investors are making good money, but should one be concerned at all about these things from the demand perspective?
See, I'll tell you what's happening with the demand. I've been saying this since the growth time. Uh, what is happening today is that the residential real estate has become a priority spend. It is no more, you know, it is not something that people earlier used to procrastinate. The young generation used to, would prefer to live on rentals than actually buy. I am seeing a major shift from 30-year onwards of this segment, which is now coming into the actual purchase of residential properties. Also, post COVID, people want better homes, better connectivity, larger homes, more spacious homes, and closer to nature, and so on and so forth. So what I'm seeing right now, in fact, what you just mentioned about the Arbor, we've got about 1150 odd units in Arbor. There will always be, in any point in time that you see in projects all over the world, you will see there will always be about 5 to 10% that will be up for trade every year. That's not an alarming situation at all. In fact, it's a very healthy situation with the kind of premium that the second and third sales are generating. That further shows robustness in the demand and the market. As far as your point about uh, the where the demand is coming from, I categorized this earlier also during our press briefings. So I am seeing, uh, I won't call it an influx, but I am seeing a very favorable uh, demand from the NRIs. I credit this to the government's outreach, led by the Honorable Prime Minister himself, with the Indian diaspora all over the world. So there is this nostalgia or a certain piece of the Indian pie that they now want to take. And what happened in the previous decade, I feel that because of unscrupulous elements coming into it, delayed constructions, foreign exchange issues, and also the NRIs had burnt their fingers and didn't want to venture into an Indian real estate market. So everybody else benefited. Today, I am seeing that happening. We worked on the NRI markets over the last 2 years extensively, all over the world. We mined, we've met, we've presented. So what you are seeing is not just a by the way kind of a thing. Yes, definitely the any tailwind is very welcome. But we have established our price points and our projects in various geographies. If you see across over the last, I'd say at least 3 years, where definitely the tailwind is helping us. But I think also the brand is very strong, and there's a certain commitment that we make to the customers, and the customers appreciate it. So I think if you look at it from that point of view, there is a good, a very robust demand that I see today, and these are people who want. And also one more important point I'd like to raise here: these are not speculators or investors. These are people who are wanting to move into better and bigger homes, and they want this to happen. So if you see it today, uh, I can safely say I have about 80-20 ratio. 80% is retail and people who are actual owners, and 20% maybe these investors or otherwise. That's what the market is today. I can speak for DLF, so that's what I'm saying.
Yeah. No, got it. That's very helpful. So that's it from my side. I'll a few more questions, but I'll jump back in queue. And all the best to Vivek for his new role.
Thank you. Thanks, Pritesh.
Yeah.
Thank you. Our next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead. Mr. Saurabh, your line has been unmuted. Please go ahead with your question. Mr. Saurabh Kumar from JP Morgan, we have unmuted your line. I would request you to unmute your line from your side and you can go ahead with your question.
Saurabh, we can't hear you.
May I request the management members, we move to the next question.
Yes, we can. Saurabh can come back later. We can move to the next.
Yes, sir. And next question is from the line of Abhinav Sinha from Jefferies. Please go ahead.
Hi, sir, congratulations on strong numbers. A couple of things I wanted to, check on slide 12 and 13, basically the development potential versus launch pipeline. So on the luxury side, you seem to have two types of products, right? So in FY25, ASP is closer to 50,000 and then it's like 30,000 in FY25. So, how does this correspond with the DLF 5 land bank or, some other product here? So that's question one. And secondly, also similarly in New Gurgaon, if you can help us explain, is the inventory now almost all the Privana type in terms of ASP, north of 15,000? Thank you.
Okay. So on the first one, you are right. The sale in 24-25 is the DLF 5. The sale in the subsequent year, which is closer to a ASP of almost 30,000 or 28,000 rupees, is actually within DLF City, but not in DLF 5. We have 2 or 3, developments, including some next round of city floors in DLF phases 1 to 4. And those typically, I think this is the fair price for those. I mean, internally, anything sort of north of mid-20s we classify as luxury. And hence, I think that's the price difference you see between 24-25 and the year after. On New Gurgaon, clearly Privana has set a new benchmark for sure. And I think there are a lot of sectors. We have about 116 odd acres in Privana itself. And then there are contiguous sectors ahead, which also, hopefully should sort of, gradually dovetail into the ecosystem. There is the New Gurgaon on the opposite side of the highway as well, which possibly could trade at a slightly lower price or may take slightly longer to come up to the same levels. But I think clearly, New Gurgaon is now definitely a early to mid-teens product, even under all circumstances. And the Privana ecosystem is clearly debuted at late 18s and hopefully should keep on strengthening from there.
Excellent, sir. And similarly, just one small doubt on the DLF 5, where we say, we have got 24 million square feet. Now, after all of these launches are done, I believe we'll still have like a lot here, right? 20 million more to go given the TOD upsides and all. Is that fair?
Yeah. So you are right that DLF 5 has about a 20 or 20 plus million of existing pipeline, and then the TOD pipeline, etc., will come in. So even at the sort of a very aggressive pace of 1 million to 1.5 million per year, I think the DLF 5 has a very deep pipeline. You're right.
Great. And so just lastly, and many more questions, but I will come later maybe. On the acquisition that you have announced just like half an hour back, can you demystify it a bit? Which land is this, and when can we actually see the transaction complete, please? Thank you.
Sure. So this is land on the Golf Course Extension Road. There's a developer there who had distressed loans from these two lenders, Stanchart and Deutsche. And we had been working with the two lenders and the developer for almost now the last better part of 12 months into trying to structure this transaction. And what we have done today is that we have signed up the documents to acquire the debt from these two lenders. And now, hopefully, in an amicable fashion, we will work with the developer to take control of these. I mean, we have identified about 29 acres of group housing land here, which should translate, including TOD and TDR, to about 7.5 million square feet of saleable area, almost bang on Golf Course Extension Road. This is Sector 61. And I think it may take us, to be fair, with all the approvals, etc., it may take us the better part of 12 months to have it ready for coming to the market. But definitely this is a geography where after Arbor we were not present, and I think this will be a very big addition to our entire sort of inventory.
Great. So this is the IREO part of the IREO bid,
Yes.
right?
That is correct.
Yeah. Okay.
That's correct.
Okay, sir. Excellent. Thank you, and we'll join back for more. Thank you.
Thank you.
Thank you. Our next question is from the line of Amit Goela from Rare Enterprises. Please go ahead.
Yeah, hi. Thank you. This question is from Mr. Khattar. Sir, now that you've got that SEZ notification which has come through, that 84%, when do you expect that to get normalized kind of situation? Because that will then improve the entire occupancy.
Yeah, Amit, thanks for asking a question. I was honestly feeling a little left out between the new launches and the pricing on the residential side.
I'll make it a point to ask you a question every time.
So I'm glad the SEZ notification came out in the beginning of December, and we have done our homework after that, and as we speak, we have already applied for all the SEZs for the floors that could be denotified under the new circular. So if we look at an overall portfolio of SEZs of 13 odd million, we have applied for 1.1 million to be denotified. Now the process is that once we do it, make the application, we have to simultaneously go to a chartered surveyor, preferably recognized by the government authorities, and work out what is the level of equivalent of duty drawback that we have to pay. And we are in the process of doing that. We believe that this, we've also been in touch with the ministry officials who will take some more time for starting to clear all this once they put the whole process in place. We believe that by March and April beginning, we should, April middle, we should be able to get these denotified. And we will be putting them on rent in the market for leasing in the month of March, and then take it up from there.
Oh, okay, so March. Okay. Thanks, Shriram. Shriram, plus this under construction downtown and Chennai, which is there, where you are saying that 90% is leased out. When do you see the revenue from this kicking in?
Yeah. So downtown Block 4 Gurgaon should be ready by the end of this year, and revenue will flow from Q1 of 25. Downtown Chennai Block 1 and 2 we should start paying. The OC has come. The tenant fit outs are going on, and we expect the rental to start from Q1 of FY25. Sorry, Block 4 will be from FY26 first quarter, and Block 1 and 2 in Chennai first quarter of FY24. And Standard Chartered will be from fourth quarter of FY25.
Okay. Standard. Okay. So most of it will kick in 25-26.
Block 4 and Standard Chartered block will kick in FY25-26. Chennai Block 1 and 2, which is 2 million square feet, will kick in 24-25.
Fair enough. And one last point on this. See, on the cash flows of DLF, like there is a dividend payment from DCDL of 258 crores. So that is what sequentially quarterly paid, or what exactly is this?
No, so Abhijit, what we have agreed now with GIC and Mr. Khattar, and Mr. Khattar agreement was a tougher one to obtain than GIC, I can assure you, is that we will take that basically Cyber City should pay dividend twice a year, every 6 months, in that sense, because it's a more predictable business. Instead of accumulating cash through the year and only paying it once, So twice a year, we should ideally they should pay dividend. DLF will still pay dividend to the shareholders, hopefully only once a year. But from Cyber City, we receive it twice a year.
Okay. Okay. Thank you so much. And finally, like Vivek, all the very best on your new assignment.
Thanks. Thanks, Amit ji.
Thank you. Thank you so much and wish you all the very best.
Thank you. Our next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead with the question, sir.
Sir, am I audible?
Yes, sir, you are.
Okay, sir, a few questions. One is, I was just looking at your RERA filings for Privana and Arbor. So your construction costs incrementally are in the 9,000 range. Is there a reason why the construction costs are so high? Is it like just a high spec apartment which you're doing? So what would explain such high construction costs? Which is because the question is essentially your gross margins should be going up, and they're not.
Right. So Saurabh, what we are doing now, given the entire material inflation in the last 4 to 5 years, is that we assume a 5% year-on-year material cost escalation, which is baked into this number. And I think there's a 5% contingency for any unforeseen expenses baked in. So actually, if you were to ask Devendra Singh, who is running that project, what if 100% of the expenses were to be outflowed today, the number may be closer to 7.5 to 75, 700. But the balance 12 to 1500 is actually the provision for the next 4 years inflation and a potential contingency. The contingency provision keeps on reducing as we keep on ordering more and more.
Okay, so your gross margins in that case should not have will have an upside only. So hopefully,
this should be okay. Because frankly, we have, you are aware that in the last 12 to 15 years, there have been a couple of cycles when inflation has caught us off guard.
Okay, got it. The second is again, on this price sustainability. So you launched Privana, which was awesome, and then your competitors also kind of cashed into the momentum and kind of did some launches, maybe slightly lower. But point is that what do you think about the sustainability of this price increase, which you're seeing in Gurgaon, which is like completely dealing with what's happening in the rest of India? So I understand the inventory is low, but at what point it becomes an affordability challenge?
So what is happening, Saurabh, is that affordability also comes with a certain degree of what you are, prioritizing in life. So as I say, your residential sales post-COVID, earlier people thought it's an aberration. People thought it's a maybe a couple of months phenomena. Then they say no, it's going to be carrying on for a year. Then they say 2 years. Now it's accepted that there is a certain set of people who have now decided to come into the fray, who historically were not buying real estate. Okay, and that's the age group of between 30 to 40. Then the NRIs have started to come back in a good way to invest in the country. So as far as price sustainability is concerned, if you see the overall infrastructure in and around Privana, let me just make that as a case in point for you. It is the hub between the Dwarka Expressway, the Mumbai Expressway, this Jaipur National Highway. So basically, if you look at it connectivity wise, and it abuts 10,000 acres of a green lung, you can't get it better. Now, with regard to the acceptance as far as price points are concerned, I think I will still choose to believe that our pricing has been very responsible, because if you see the kind of madness that was going on in Gurgaon earlier, we have kind of not only we have kept ourselves away from that greed and that lure, and demonstrated this very strongly both in Arbor and in Privana, that we could have picked up at least 2,000 rupees per square foot more, which we didn't. So we kept money on the table for the investors. So that is one. Second, as far as we are concerned, and as far as Privana is concerned, the ecosystem, the entire ecosystem and the contiguous land parcel that we have, I am calling it the DLF 6. So all the learnings that we have had in DLF 5. Obviously, DLF 5 is super luxury, so not comparing it apple to apple, but I'm saying all the learnings of infra, social infra, and everything else that we had, we will be, taking that to Privana. So you will only see an price increase. And again, I think what has happened today is that there is a certain set of people. If you see, the size of investors has increased over the last 3 years, and the acceptability of residential real estate investments as an asset class has now become the top priority. So I think that is what is it. If you see what was happening to the capital markets over the last 5 years, why aren't people saying that how come investments went from certain billion to certain billion? Where are you seeing that? Will the FIs pull out? Will individual retail guys? So everybody is trying to grow their market, but in the real estate thing, I'm seeing a very sustained demand, Saurabh, and I
Okay.
feel that this is 80% because a lot of these investors. In fact, let me make another point clear to you. I this time even deduped the Arbor data, so people who got the Arbor were not in the line of preference for Privana. So not people that, and in fact, I'm extremely wary of these fly by the night investors, because we'd rather have, and we have enough people wanting to get better homes from DLF. Saurabh?
Okay. I think, yeah, you are the guy with the golden touch, sir. So I just want to just add on to one thing on this price thing, because see, Privana's price is what Magnolia's was like, 8-9 years back. I mean, that's my limited point, that Magnolia's traded at 18,000, Privana under construction, you kind of got to that price. So, but maybe I'll take it offline. Just one last question.
Happy to tell you what Magnolia is trading today at 55,000 to 60,000 rupees a square foot.
Yeah. No, I understand that. Okay.
And
Just one last.
These are second and third sales, Saurabh. So I'm not even, I mean, yes, I have a very strong retrade team which is assisting people there, but that's what the price points are in Gurgaon today. And if you're wanting a better life, you want, I say it's a great melting point. It is not only just price point related, it is also becoming the most preferred destination for living, both from the infrastructure point of view and the social infrastructure point of view. And of course, the connectivity to the airport and everything else. 95% of the offices, big Fortune 500 companies are there, good schools, a great ecosystem, fantastic golf courses, leisure opportunities, cinemas. You don't need anything out of this, this zone that has been created.
Okay, so maybe next time in Gurgaon we can see that new Gurgaon master plan. So just the very quickly moving on. So just on the construction spend, your construction spends now go up very substantially from here on, because the sales velocity. And I mean, are there any changes you've done, because now you're giving fully fitted out apartments? Historically we've had delays. Are there I mean, as your spends go up, are you confident of meeting the timelines you've kind of thought about? Because your sales have gone up roughly 6x. I mean, the deliveries will have to keep pace. How do you think about that?
So you're right, Saurabh. So I think the two things we have done is obviously significant strengthening of our construction teams on the ground, and also a significant diversification of the contracting ecosystem, frankly. So we are no longer working with just the 2 or 3 super grade A, contractors. We have diversified. We have strengthened our sourcing team. We have strengthened our accounts payable team. So, the entire value chain of that entire construction process, we have definitely, because we clearly understand that could be a weak link if it's not focused on. And I think that's what we are doing, Chief.
Okay. And just one last question. When do you see the P&L acceleration in terms of revenue recognition? When should that start to happen? Maybe we can answer that before he leaves, and we'll hold him to account still in the new company.
I think this was asked earlier as well. So I think it's a matter of time before this new sales will start converting it into revenue. So I think possibly my estimate, it will take another 2 years before you see the revenue actually growing almost in line with the new sales booking.
Yeah.
Okay, got it. Thank you.
Thank you. A reminder to all participants to ask a question, please click on the Q&A tab on the panel and click on the raise hand button. The operator will announce your name when it is your turn to ask a question. Please accept the prompt on your screen and unmute your microphone while proceeding with your question. Thank you. Our next question is from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks for the opportunity. So my first question is, I wanted to have your view on the demand for independent floor segment, especially in Gurgaon. So is the momentum continuing like what we were seeing, last year, last 2 years, or was it more like a post-COVID trend and now home buyers are back to buying apartments? So any thoughts on that? And within our launches, how much are we, what share is independent floors for FY25 in the launches?
So independent floors, most of it that we've sold. In fact, we just got the last 30 odd units to go as far as floors are concerned, independent floors. And one thing that, since you asked that question, I'd like to say, because we keep doing these analysis even within, there's a certain set of customer who only prefers to be in these floors or independent homes. The managing independent homes is becoming quite a hassle for most of the people. So people are graduating to living in floors, and there is a little bit of a community thing also. Yet it is tradable and manageable. So also happy to let you all know that the DLF independent floors are being traded at a premium of upward 15 to 20%, which are happening today, and the set of people, and there are plenty, because if you look at upcountry, they've not lived in condominiums. If you look at Delhi, most of Delhi has never lived in condominiums. So I have a massive, I'd say, interest that comes in and demand that comes in from upcountry as well as Delhi. People who historically lived in independent homes or even floors there are now starting to upgrade because their children go to school here or they work here. So I'm seeing a lot of those people wanting to move here. If they had the choice of condominium living, they chose independent floors. So as a brand, I will continue to say that I don't have much, to your second question, I don't have much in Q4 or Q1 of independent floors. But if I can answer it this way, should I get an opportunity, I'd look forward to it.
Okay. Okay, understood. My second question is, in your land bank slide, you mentioned, in the comment below that the TOD potential is not being considered. Could you give some color around this? How big could this be, and which areas is where you see the maximum TOD potential? And when does this come into your land bank, or when does this come into play? Only once you exhaust the existing pipeline, or it could be more opportunistic? So some color on that. Yeah.
So whenever we launch a project, so as an example, when we launched Privana, we looked at the TOD, TDR entitlement that Privana had and tried to maximize that. So it's not that only once we complete this 187 will we start, engaging on TOD and TDR, because TOD and TDR is used on the existing land bank. It sort of retrofits on the existing land bank. So this will be done on a project-to-project basis. They will, in all fairness, some micro geographies in Gurgaon also, where we may not be able to consume the entire TOD TDR entitlement because of either height restrictions or footprint restrictions on account of buildings already built. So this is a WIP in all fairness, but I think this will add to this number by a significant margin for sure. But we are not letting TOD TDR lapse. Whenever we are doing a new project, we try to sort of assess the maximization of TOD and TDR we can do in that project, both on the DevCo side and on the RentCo side.
Okay. Okay. And okay, understood. And lastly, any update on the Midtown Tower D launch? Are we planning to launch this in FY24 or will it spill into FY25?
You know, what has happened is with all this hula bula that Gurgaon has been, you know, all the attention that Gurgaon has been getting, we have almost sold out Tower D. We've got the last 70 odd units left, you know, of one midtown.
Before the launch.
Even before we planned it to do this in Q4, first Q3, Q4, but we are almost cleaned, you know, just 70 odd units there. So I don't think it merits a launch. And there's just Tower D left now. The 4 bedroom we had always planned to do with the club launch, which is sometime in Q1 or Q2. But I don't think really now, you know, that I don't think we're going to be doing a big bang launch or anything. We're almost, you know, out of 225 to 235 odd units, we're almost there, just 70 units to go. So that will also, I think, we'll clean this up this quarter. So I don't think there'll be a launch anymore there.
Okay, that's perfect. Thanks a lot for answering my questions and wish you the best, Vivek.
Thanks, Mohit.
Thank you. Our next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi, sir. Thanks a lot for the opportunity and congratulations on a great quarter. So after achieving a guidance of 13,000, so what are the next targets for FY24 and 25?
So, I mean, depending on how the entire launch pipeline pans out, clearly we will be looking at a number which is at least a moderate increase from what we achieved in FY23-24. I mean, traditionally, as you know, we come up with the sales guidance for next year, typically in the annual closing analyst call, which will be in early or mid-May, which is when we would update this. By that time, this entire thing on when are we launching Privana 2, the final timeline on the DLF 5 launch, all of these uncertainties would also have been frozen by then. So, but I clearly look at a number which is, hopefully a 15 plus number at a very moderate level for next year.
And even for FY24 now being done 13,000, so looking at that 15,000 crores plus for the full year as a whole.
So look, I think as Akash mentioned earlier, also in some of the interactions post Privana, we are trying to see if we can advance the launch of one major project which is currently slated for Q1 into Q4. I mean, obviously the market is there, the customer pipeline is there. I think it's a question of can we get all the approval processes done by mid-March for it to launch. So I think there will be a launch Parikshit definitely before the end of April for sure. Whether it happens on 15th March or 15th April is something that I think we are not necessarily losing our sleep about. But I think clearly we do expect that the next round of Privana should come to the market, hopefully, in the very near term.
Oh, great. Just the last question on this new land bank, which we have announced. So you said 7.5 million square feet will be, I understand, the carpet area and 12 odd will be sellable. So this 825 crores will be the total consideration.
Parikshit, 7.5 sellable is what we said.
Sorry, sir, what?
7.5 million square feet sellable area.
Okay, it's sellable because I think you earlier mentioned 12.5. So I think it's just correcting that. So this 825 is the crores is the total consideration for this sellable area, and beyond this you will also need to invest on TOD.
No, 825 crores was the outstanding loan that the developer had vis-a-vis these two banks. Actually, the loan was I think 1,200 crores. The bankers agreed to take a haircut as a one-time settlement. So 825 is what we have bought the loan at from the bankers. We are in the process of finalizing our agreement with the developer for acquisition of this 29 acres with the requisite FAR. And I think whatever is the delta would then need to be paid out. So 825 is not the consideration for 29 acres. The consideration would be slightly higher than that. But 825 is the price at which we have bought these bonds from the current bondholder, so that now we are the lender and we will now run that process in an amicable manner to acquire the targeted land.
And what will be the total development potential in terms of value? 7.5 syllables. What kind of sales
I
potential
mean,
could this
I don't
project
want to
have?
hazard a guess, but Akash Golf Course Extension Road, what will be the sale price? So I think 7.5 would be late teens, but
Uh, I'll let Saurabh speculate that.
yeah.
He felt 18,000. So I'm dreading saying anything to you all.
18 se zyada hoga, don't worry.
No, it's a fantastic parcel. We're very excited about it, and it'll be a, hopefully soon as we get it, I think it's going to be a good turnaround. Also, you know what the golf course road is trading at today. At this point in time, I think let us get into the market a little bit. Let us do our surveys, but it will be a good number. Again, responsible number.
But I mean,
And this is not included in the
no, this is not included in the launch guidance because the launch guidance was prepared yesterday evening and this agreement was signed today afternoon.
Okay, sir. Okay. Thank you. Thank you, sir. Those are my questions.
Thank you. Our next question is from the line of Kunal Lakan from CLSA. Please go ahead.
Yeah, hi, good evening. Just wanted to understand, like, since Mumbai is second in line after Gurgaon in terms of launches, what are the specs that we are looking at? What kind of units, what kind of ticket sizes we'll be launching there?
So right now it's going to be premium plus thing. Ticket size again yet to be fully finalized, but be between 5.5 to 7.5 crores. And uh, and as far as the sizes are concerned, we're just about, yeah, it's three bedroom plus, but we're just about finalizing all that. But it's going to be a good development again in the lines of what DLF does with infrastructure and all that, and of course the lifestyle quotient with the club and everything else will come with it. So as far as the product is concerned, I mean the first cut has come out pretty well. So yes, please keep a lookout for us, and I think that's the price point that at this point of time that we're looking at. But I am now going to be spending some time in Mumbai, starting, say maybe February, March onwards, and some realization price thing we'll kind of do once we are on ground. But more or less, we've got an idea of what we're going to be launching at, and I think, yeah, I mean we're also pretty excited to come to Mumbai. So yeah.
Sure. And any update on Tulsiwadi? I mean, Mumbai also has been doing well, especially the luxury bit, right? And that location is like, well sought out for. So any update there, and any timeline that we internally hold that to start that looking at monetizing that project?
No. So I mean, Tulsiwadi, obviously, we are currently at the rough end of the legal fight. I mean, as you may have read about 4-5 months back, one of the three shareholders, frankly, I mean, basically, I mean, the land was sort of, auctioned in a very less than transparent manner to an ARC who transferred it to an affiliate of one of the shareholders. So currently, both us and Shapoji Palanji are in extremely intensive litigation, with frankly both the lenders, PNB HFL, and the concerned ARC, and we are hoping for a just fair and equitable resolution of that. So clearly, it's not coming up for a launch anytime soon because some of these legal issues have to be resolved.
Sure. And lastly, we are generating these very strong free cash flows, both in DLF as well as DCCDL. But in terms of our new business plans or new development plans, I mean, we got into Mumbai, but are we looking at any other market actively besides Mumbai on the west or on the southern side?
So we are clearly looking at certain opportunities from a growth standpoint. As you recall, Vivek always used to say that free cash flow will be used for shareholder returns and growth capital. So we are clearly looking at growth capital. But truth be told, most of our opportunities that we are pursuing right now are within the NCR fold, in that sense, which is where I think we have a strong presence and hopefully can deliver value.
So we've actually taken Vivek's guidance very seriously.
So abhi growth to aayegi.
Sure. Sure. Khattarji, one quick question for you. We did highlight that, last time that we are seeing discussions or interest coming back from GCCs, although nothing has been put on, paper yet. But are we seeing incremental signs of new leasing coming back, especially from the larger players, larger GICs and MNCs?
Yes, the demand or the interest from GCCs continues to be robust, and I believe that in the next few quarters it will only grow. When these GCCs come to India, they look for 3-4 aspects where I dare say, at the cost of, when I don't want to be immodest, where we are able to sort of satisfy quite well. One is they look at what levels of sustainability do we have and what steps do we take in that area and in the area of ESG. Second, they look at what we can provide for the employees of these GCCs who come in terms of social infrastructure and better quality amenities, safety, security, etc. Third, they look at scalability. And fourth, they look at the quality of the real estate developer. So I think as we go forward, this definition of so-called grade A office space at 700 million will slowly start getting segmented, where we will have grade A plus plus office space and grade A office space. And grade A plus plus office A, I dare say, would be between 150 to 250 million. And that is the segment in which we would continue to operate and grow.
Sure. But in case, in a sense, that are you expecting larger deals to start closing from, say, a couple of quarters?
Yes, we expect larger deals to close from a couple of quarters. I may share with you a deal that was closed recently. To our surprise, one of our tenants wanted to see our pipeline of growth for the next 7 years. And this was in Gurgaon, and when we shared that with him, downtown phase 2, for which only we have started doing the rafts and preparatory work on the site. There was a building, we have 4.5 million square feet of offices coming behind the mall, and that's a total of about 7.5 million development. So this very marquee GCC took 160,000 square feet with deposits, with an option, hard option, to take on another 160,000 in a building for which we have not yet started construction. We are having also strong inquiries on our joint venture with Hines, which in terms of timing we had planned well. So say downtown 4 gets delivered end of this calendar year, and the joint venture with Hines, which we call Atrium Place, those buildings start getting ready from say April, May of 25. Therefore, they are well sort of timed. And by the time they get completed, we will have the phase 2 of downtown delivery starting to come in place with a lag of about 6 months to 12 months.
Sure. Thank you so much, and all the best to you, Vivek. Thank you.
Thanks, Kunal. Thank you.
Thank you. Our next question is from the line of Abhinav Sinha from Jefferies. Please go ahead.
Hi, Khattar sir, just a quick follow-up on Kunal's question. So, on the rent side, are we seeing some movement, or it's still a few quarters away?
No, touch wood, we are seeing the rents getting not only stabilized but moving up. I'm pleased to share that the last lease that we did in downtown 4 was at
150 rupees a square foot. And the last lease that we did at downtown in Chennai was at 100 rupees a square foot. So we are seeing rentals slowly inching up. Cyber City, our budget for this year was 114 rupees, and we'll probably be doing slightly better than the budget in the current year.
Right. And the last one on DC CDL transfer that we have seen, the city center. So, I mean, are we looking to transfer the remaining also from DLF and, including the ones, the malls, I think, which are under construction?
So one thing we have realized is that it's frankly, from a value relation standpoint, it's always best to transfer assets once they are completed and rent yielding versus when they are in the development phase and subject to a lot of assumptions on valuation, etc. I mean, if you recall, we had transferred the parent Cyber City assets in December 17. Transferred the next rung of assets in if I'm not September 2019. In some sense, this is the third tranche of those assets. So we, the DLF DLF Center transfer required the permission from the minority shareholders. So hence we have taken to the audit committee and board this time, and now we'll run the minority shareholder process. And hopefully by the time this closes, we may also be looking to transfer one or two other assets which are currently in active rental on the DLF side of the equation onto Cyber City, assuming we are able to settle the price and other terms agreement with GIC at Cyber City.
Great, so thanks and all the best.
Thank you.
Thank you. Our next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
So just a few follow-ups. So one is this Atrium Place, it says sales value. So, I mean, the intention is to sell it, or it's part of your development that is 7,000 crores, or is that just the capital value?
So this is the capital value. I mean, the idea being obviously, Saurabh, that at some stage, as and when Cyber City, does have a monetized solution, the Atrium Place may also be potentially contribute to that. But this is a building hardcore for lease. This is like a classical rentco asset, It's just that as and when the monetization proposition or solution comes up for Cyber City as a whole, we'll talk to Heinz at that time to see also if he can contribute that as well into that mother vehicle.
Okay, and basis current visibility, sir, where will you think the exit rental or for F25 stabilizes now?
Saurabh, I was waiting for this question. It should stabilize between 51 and 5,200 crores. Fiscal March 24, March 25. FY25.
FY25. Okay, 51, 52. And this will exclude it excludes Atrium, right? I mean, Atrium will be.
Yeah, it excludes Atrium.
Atrium, no, sorry. Yeah.
So okay. Saurabh, this is March 24.
No, March 25.
March 24 exit.
March 24 exit is 52.
Yeah. He's talking about.
And in the parent, should be at the current run rate, right? In DLF.
DLF Center come ho jayega. DLF Center will get reduced from parent and go into Cyber City. So that 65 or 65 crores will get added to Cyber City.
No,
but nothing is completing in DLF in the next 1 year, right? None of the malls you were building or the
malls will come into play in the fiscal.
Noida will come into play, na? So that's about 50 odd crores.
55 crores in Noida. Yeah.
So what will happen on the DLF side? That one side, once the DLF Center deal is consummated, about 60 crores of rental will shift from DLF to DCCDL. Yeah. But in DLF, the data center 1 and about 500,000 of IT power, that will start yielding rents of roughly an equivalent amount, maybe 5 crores here.
Yeah. So basically DLF remains constant, that goes up. Okay, got it. Just one last question, sir, on this deal which you've done. To me, like effectively your property prices are going up. But if I look at the transaction and even if I make assumptions around land cost, other charges, land cost is not going up, right? So you're basically buying 7.5 million square feet for less than, I don't know, maybe 1,500 rupees a square foot.
Yeah. So you are
that. So that's a very sweet spot for you as a developer to use cash, when land price is not going up, property prices are going up, so your incremental margins are better. I mean, if you want to comment on that.
So Saurabh, you are right that and very rough back of the envelope computations from the agreed land cost and all the governmental charges required to go up to the peak for 4.5 plus FAR. I think our landed land cost will come to around or less than 2,500 rupees per square foot of saleable area, you know. And so obviously given the price points, hopefully in the Golf Course Extension Road, that is a fairly sweet spot.
So shouldn't you be doing more of this? Like, I mean, this is like the situation doesn't last for long, right? Because
this transaction has taken 19 months of
Akash
my
can anyway
life.
sell.
19 months of my life, my SB1 AC has shot up by about 20% in this transaction. So we'll do it as
It takes
they
only
come.
2 days for Akash to sell it. Yeah.
But these are, I mean, no, I mean,
the sugar levels of Akash and Ashok are constant.
but I mean, navigating this distress asset piece is a maze in itself.
Okay, got it. Thank you.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. I would now like to hand the conference over to Mr. Ashok Tyagi for closing comments.
Thank you. So, obviously, I would like to thank all of you, for again coming out and supporting us. Yes, we have hopefully had a very good quarter, and I think this is the harbinger of possibly, not only the next quarter, but hopefully the next, couple of years, if not longer. I mean, both the DevCo and the RentCo, both offices and malls, I mean, really all the segments are firing right now in unison. I mean, the one delta there was with respect to SEZ lands, and that also has now been rectified. So hopefully, all the engines of the company should be working together. Our free cash flow is now reasonably strong. We have, as mentioned earlier, we'll keep on distributing that across shareholder returns and growth capital. So I think overall, I think the company is definitely hopefully looks to be. I mean, the company and the industry look to be in a relatively decent zone. I also like to take this opportunity, frankly, to thank Vivek, who I think in the last 4.25 years or 4 years plus, 4+ years, honestly has been tremendous in terms of putting sanity in our processes, in our cash flow systems, in terms of strengthening of not only the teams below him, but also the IT networks. I mean, in some sense, I think he was exactly what we needed. And, while we tried our level best to have him stay back, he wants to ride a motorcycle now, so which is okay. But again, on behalf of all of us, I think we once again thank him enormously for what he contributed here. Sir.
Thank you.
All the best to it.
Thank you.
Thank you.
Thank you.
Thank you. Thank you.
On behalf of DLF Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.